Hello everyone, and welcome back to Boss Economic World. I'm your host, the Boss, and this is the only show that cuts through the noise, the official statements, to tell you what's really driving the global money machine. Today is October 31st, 2025. It's Halloween. And let me tell you, the European economy just knocked on our door. It's holding out a big bucket, and on the surface, it looks like it's full of candy. But as we always do here, we're going to look past the shiny wrappers, because I have a sneaking suspicion there's a nasty trick hiding at the bottom of that bucket. So, let's get into it. The big headline that just dropped from Eurostat, the EU's number crunching department, is that euro area inflation came in at 2.1% for October. Now, for the average person, and even for some folks on Wall Street or in Frankfurt, that sounds fantastic, right? The European Central Bank, the ECB, has a magic target of 2%. Hitting 2.1% is like trying to park a giant container ship and getting within inches of the dock. It's close enough to pop the champagne. After the inflationary nightmare of 2023 and 2024, where prices for everything from your morning croissant to your electricity bill went to the moon, this feels like victory. Christine Lagarde, the president of the ECB, basically said as much yesterday. She stood at the podium, cool as a cucumber, and told the world, from a monetary policy point of view, we are in a good place. And look, based on that one number, you can see why she's projecting calm. The ECB has been on a brutal campaign. They jacked up interest rates from negative territory all the way up to the current 2%, where they've been sitting for 3 straight meetings. This was a shock-and-awe tactic designed to make borrowing money more expensive, cool down the economy, and put a lid on runaway prices. Seeing inflation at 2.1% suggests the plan worked. Mission accomplished. Time to go home. But you, my friends, are not watching mainstream Money Minutes. You're watching Boss Economic World. And we know that the headline number is often just a smokescreen. So, let's do what we do best. Let's lift the hood and see what's really going on with this engine. When economists talk about inflation, they're really talking about two different beasts. First, there's headline inflation. That's the 2.1% number. It's the flashy one that gets all the press. It includes everything in the consumer basket, including the two most volatile characters in the whole story, food and energy. The price of oil can swing 10% in a week because of a geopolitical flare-up, and the price of wheat can jump because of a bad harvest. These things are important, but they don't always tell you about the underlying health of the economy. Then, there's the beast that keeps central bankers up at night, core inflation. Core inflation strips out food and energy to give you a clearer picture of the long-term price pressures built into the system. It's the difference between the weather today being surprisingly sunny and the climate trend showing the planet is steadily getting warmer. So what did the core inflation number for the Eurozone come in at? It held steady at 2.4%. Wait a minute. The big, flashy number went down, but the real underlying number is stuck at a higher level? Exactly. This is trick number 1 in the Halloween bucket. While cheaper gas prices might be making the headline number look good, the fundamental cost of doing business and living life in Europe is still rising faster than the ECB wants. But hold on, it gets even more interesting. We can break down that core number even further. The most important component, the one that really tells you what's going on, is services inflation. This is the price of your haircut, your insurance, the meal at your favorite Italian restaurant, your plane ticket to Majorca. And what did that number do? It accelerated. It went up to 3.4%. Now we're getting to the heart of the problem. Why is this so scary for the ECB? Because unlike a barrel of oil, the price of services is almost entirely driven by one thing, wages. Think about it. The price of a barrel of oil can crash overnight. But has your dentist or your accountant ever called you up and said, good news? Our wages went down, so we're charging you 10% less this month? Of course not. Once wages go up, they tend to stay up. This is what economists call sticky inflation. And right now, that stickiness is looking like superglue. A 3.4% rise in services prices tells us that workers across Europe are still demanding and getting significant pay raises to cope with the cost of living, and businesses are passing those higher labor costs directly onto you, the consumer. This isn't a temporary supply chain issue from a tanker stuck in a canal. This is a fundamental, self-reinforcing cycle. Wages go up, so prices go up, so workers demand higher wages, so prices go up again. This is the dreaded wage price spiral that gives central bankers nightmares. As Jörg Kramer from Commerzbank put it, the persistent underlying inflation argues against the ECB further lowering its key interest rates. That's the polite, economist way of saying, are you guys crazy? You can't declare victory when the real fire is still burning in the basement. So if the problem is so obvious, why doesn't the ECB just hike rates again and finish the job? To understand that, you have to understand that the euro area isn't one economy. It's a family of 20-plus countries forced to sit down for a very awkward family dinner, and they all want to eat something different. But the ECB only has one dish it can serve, a single interest rate. Let's look at who's at the table today, based on the latest national data. Spain is the cousin who just won the lottery and is ordering champagne for everyone. Its inflation is still running hot. Its economy is booming, fueled by a massive post-pandemic tourism rebound and strong domestic demand. For Spain, the ECB's 2% interest rate is like trying to put out a bonfire with a water pistol. They need higher rates to cool things down. Germany is the responsible older brother who used to pay for everything but is now feeling a bit sick. The industrial engine of Europe has been stagnating for a year, narrowly avoiding a technical recession. Its factories are being hammered by high energy costs and slowing demand from China. For Germany, the ECB's 2% interest rate is already painful. Hiking rates further would be like kicking them while they're down. France and Italy, these are the siblings who are just trying to get by. Their inflation is actually well below the euro area average. France's economy showed surprising resilience this quarter, growing 0.2%, but its inflation is still tepid. Italy is also stagnating. For them, a rate cut would be a welcome relief to stimulate growth and create jobs. Now, you see the problem? Lagarde is sitting at the head of this table. Spain is screaming that the room is on fire. Germany is shivering and asking for a blanket. France and Italy are asking for another helping of dessert. And she has one thermostat for the entire house. If she raises rates to cool down Spain and crush that sticky services inflation, she could shove Germany and Italy into a deep, painful recession. If she cuts rates to help out Germany and Italy, she risks letting inflation in Spain run wild, which could reignite the fire across the whole continent. This is the fundamental, and perhaps fatal, flaw of the single currency project. It's an economic straitjacket. So what does she do? She does what any politician, and let's be clear, the ECB president is as much a political role as an economic one, does in an impossible situation. She does nothing. She holds rates steady and says, we are in a good place, hoping that by some miracle, everything will sort itself out. As if managing that dysfunctional family wasn't hard enough, Christine Lagarde has to look over her shoulder at two massive, unpredictable forces. First, the ghost of Donald Trump. It's 2025, he's back in the White House, and his America First trade policy is throwing wrenches into the gears of the global economy. His administration has slapped a new round of tariffs on goods from China and other parts of Asia. Now, you might think, that's their problem, not Europe's. Wrong. The global economy is a plumbing system. If you block a pipe in one place, the pressure builds up and a leak springs somewhere else. These tariffs are having a bizarre, two-way effect on Europe. 1. The deflationary flood, a Chinese-made electric car or a shipment of Vietnamese solar panels that was heading for Los Angeles suddenly gets hit with a 25% tariff. The manufacturer can't sell it there. What do? They divert the ship to Rotterdam or Hamburg and dump the goods on the European market at a discount just to get rid of them. We're already seeing this. An ECB report from last week, summarizing their talks with businesses, showed that manufacturers are seeing downward pressure on prices precisely because of this trade diversion. This pushes goods inflation down and makes the headline number look better than it is. 2. The inflationary snarl, at the same time, a sophisticated German car manufacturer, say BMW, relies on a specific microchip that is assembled in Malaysia but passes through a testing facility in the United States before arriving in Munich. Suddenly, that supply chain is disrupted by the tariff chaos. BMW now has to scramble to find a new supplier or reroute its logistics, which costs time and money. Those extra costs get baked into the price of a new 5 Series. This pushes core and services inflation up. So Trump's tariffs are simultaneously helping the ECB on the surface while making its core problem even worse. It's an absolute mess. The second wildcard is the strong euro. As the US Federal Reserve, led by Uncle Powell's successor, has signaled it might start cutting rates soon to deal with its own slowing economy, the euro has strengthened against the dollar. A strong euro is a double-edged sword. It makes imports cheaper, which is good for fighting inflation. But it also makes Europe's exports, like German cars and French luxury goods, more expensive for the rest of the world. This hurts economic growth, putting even more pressure on the already stagnating German and Italian economies. So let's bring it all together. Where does this leave us? The European Central Bank is trapped. They are walking a tightrope over a canyon. On one side is a resurgence of runaway inflation. On the other side is a deep and damaging recession. Christine Lagarde's good place is this razor-thin tightrope. She's holding a 2% interest rate like a balancing pole, praying a gust of wind doesn't blow her off. The headline inflation of 2.1% is the treat. It's the sweet, sugary morsel designed to make everyone feel good. But the tricks are terrifying. Sticky services inflation, a deeply divided continent, and chaotic global trade wars are all hiding at the bottom of the bucket. The ECB's own forecast admits this is a long game. They expect inflation to dip below 2% next year but then re-accelerate back towards the target in 2027. Their next big meeting is in December, where they will release forecasts for 2028 for the first time. The entire market will be watching to see if their models show this problem fixing itself, the mythical soft landing, or if they signal that more pain is coming. Right now, the risk of stagflation, the toxic combination of stagnant growth and high inflation, is higher in Europe than it has been in decades. It's the worst of all worlds. Your wallet is squeezed by high prices, and your job security is threatened by a weak economy. So, when you see the headlines celebrating Europe's victory over inflation, remember what you learned here today at Boss Economic World. The party is far from over. In fact, it might not have even started. The ECB has bought itself some time, but it hasn't solved the fundamental problem. The two-headed inflation dragon has been wounded, but it's not dead. And it's hiding in plain sight, in the price of your coffee and your commute. The battle for Europe's economic soul is just getting started. Stay sharp, stay informed, and don't let the headlines fool you. Until next time, I'm the boss, and this has been Boss Economic World.